Welcome to Beyond the Bottom Line, the podcast where founders and business owners get in-depth insights and actionable takeaways from industry experts. We're here to help maximize your revenue, streamline your operations, and keep more of your hard-earned money. Now here's your host, Miguel Alexander Centeno.
Thanks for joining. I'm Miguel, founder and CEO of Centurion Firm, while I have the honor of leading a small tax strategy team serving businesses just like yours. And the cool thing about what I do is I get to work with business owners who are doing much cooler things. I do a deep dive with clients, mentors, and businesses I admire about their world, how they think about their topic, and how you as a business owner, operator, or investor can learn from the best. Joining me today is Ari Rubin, founder and CEO of Flock Homes. And the reason I'm so excited to have Ari on is to explain how Flock Homes is changing the way to invest in real estate. You should be in the right place if you are here to listen about maximizing tax efficiency using cost seg and 721 exchanges. We are constantly looking for other companies, other strategies and concepts of how to grow and keep your wealth in your way. And that's something we think a lot about. And I think it's something that we honestly know that we don't have all the answers to. So when we run into other companies, other ways of investing your money, of building tax strategies, we're always really excited to share those with our clients in the context of the journey of learning how to grow and keep your wealth. A quick aside that I thought was interesting, I recently read an article put out by Morgan Stanley about how millennials are investing. And I always think it's really interesting when a company that skews a little older writes about it. And one of the things that they said was that millennials are going to be the value investing class, not in the Warren Buffett sense, in the sense that we vote with our values, our wallet follows our values. And I think that's right. But I think they got wrong is that they start going into all these causes that they think millennials are going to invest in. I think that's really wrong. I think what they got right is that I would say generationally and for people of all ages, we're getting really intentional about investing the way that aligns with how we want to live life. And that's why I think I'm particularly excited about Flock Homes. So no matter what generation you're in, I think the era that we're in is finding a way to invest your assets to grow your wealth in a way that aligns with the life you want to lead. And for reasons you will find out in a moment, Flock Homes is a really interesting way that they're doing that. We'll talk about two strategies. We'll breeze over cost seg because if you follow us and know us, we talk about it a lot. I also think it's really interesting to get into what a 721 exchange is. I had the benefit of having Ari here on the call explain it to me. And I just thought, man, we've really got to have these guys on. What we know about the government is the government is happy to run at, I think, a $38 trillion deficit. They do not need your capital as much as you do. We philosophically and fundamentally believe that every entrepreneur and investor is a better capital allocator than the government. That's not a political view. It's an economic view. And for that reason, we're always very keen on sharing how to do that, how we're doing that, how we're seeing our clients do it, and how we're seeing some of our partners do it. So with that, I'm happy to introduce Ari. Ari started Flock after experiencing the challenges of being a landlord himself. Prior to Flock, he worked as a hedge fund manager at IBEX Investors, managing over $150 million in assets. Ari attended Stanford's GSB and received his AB from Harvard University. So with that, Ari, I want to hand it over to you. Pleasure to have you on.
Yeah, Miguel, thanks for having me. I'm really psyched about what you guys are doing, the clients that you're serving and all the content that you guys put out across the board. And I'm really psyched to talk about the exchange today and also learn more about cost seg. We were getting into the weeds yesterday, but really psyched to learn more.
Yeah, absolutely. And we're super excited to hear about 721. I just wanted to hear quickly, was there kind of a moment or a day where you're like, that's it, I'm starting a new company, and then we'll get into the content. But tell us a little bit about the starting.
Yeah, I'll give you the quick, founder's journey here. So as you mentioned before Flock, I worked at a small emerging manager hedge fund. And my job was investing on behalf of high net worth individuals, small family offices. The fund I was running, I was seeded with like $1 million, and the fund did really, really well. We had awesome returns. But the reality was we were taking a lot of risk in doing that. And we were in a really, really good trade at a really, really good time. And I liked investing on behalf of people. I was trading really highly levered volatility derivatives products. I have a very strong fiduciary to clients. And I take really, really seriously what people are investing me with. And I wanted to do that and build a business that was not only going to do that for many generations, but that was also going to solve a lot of problems for folks. You're in the problem solving business. Like, you work with clients, you help them keep more of their wealth and let it compound and invest and let them live the lifestyle that they want to live. Similarly at Flock, that's what we're doing. We're in the business of solving a problem. And so I ended up quitting my job at IBEX and I went off to Stanford for business school. I ended up dropping out and really.
That actually gives you more credibility these days.
I know there's all those elite institutions, like, they're kind of dirty words these days. And so, yeah, I dropped out to start the business back in 2021. And I'll tell you guys a little bit more about how the exchange works and how it's doing. But we started with 4 landlords, 4 owners, 4 homes who were entrusting us with this crazy new idea. And they were handing over for a bunch of them, a huge chunk of their nest eggs, their savings. And fast forward today, we have about 1,100 homes that we own and operate across the country. We've worked with hundreds of families, paid out millions of dollars of cash flow, and served, thousands of residents around the country, which is something we're really, really proud of. So, and of course, from a tax perspective, helped defer probably tens of millions of dollars, if not more, of taxes, the tax liabilities. So really psyched to get into that.
Yeah, no, it's an important measurable. And I think, it's good that we're leaving things for later, creating some of that excitement and curiosity. But I will say, just as kind of a reaction, I mean, we don't do this with partners who are just getting started, who are just figuring it out. I mean, I think what you just shared is a testament to the scale. And as we'll talk about your model, I mean, you need validation with individual investors in order to scale. So, that you're at a number here that just, to me, sounds incredible, I think is a huge testament to what you're building. So we're going to leave that as a teaser for now to talk about cost segregation. We serve a similar market. So you're a real estate investor. And oftentimes what you're thinking about is, look, I've already committed the capital. I've already committed to the way that I'm operating this rental. What tax strategies exist without me doing anything new? And that's where cost segregation falls in. So I always remind clients or prospects that cost segregation is really valuable. Even if 3 or 4 years ago, you already bought a rental property, because we can retroactively go in, collect missed depreciation all in 1 year without having to amend 4 tax returns. So it's a really, I think, important strategy for real estate investors. And as we'll talk about in a second, we'll talk about why and how it applies and when it doesn't apply as well. So who does cost seg really work well for? If you follow us, we serve a big demographic of short-term rental operators. If you are a short-term rental operator, you can treat the business as an active trader business. There's a publication and a loophole and exceptions there that we apply to make sure that applies. So if you have an active loss, it's going to offset your other income, ordinary income, business income, W-2 wages. So that's where it's really valuable. And you also get that treatment if you're a real estate professional. There's an hours requirement, but you'll often hear other investors who have a portfolio. They will spend enough time and just qualify based on the number of hours they spend as materially participating. Now, the other option, I'll just breeze by, but if you're a business and you have a self-rental, meaning you own a commercial property, maybe it's even an ADU that you've set up on your property that is 100% for the business. We're not talking home offices here. Those have an opportunity to take cost segregation within the business on the business's P&L. Commercial property, that's an obvious one. If you bought a commercial property, I think it's a really big strategy. We're talking lots of property. We'll get into an example in a second, but we're talking big savings because the purchase price is bigger, and the QIP rules around commercial properties are a little more I think, defined than residential. But we'll skip that for now because I think most of the focus is going to be on residential properties and investments when it comes to being a long-term rental owner. And then we have here this taxpayer who meets a $25,000 offset. And what that means is that if maybe you're in a stage of life where you've already retired and your AGI is below that 150, then and let's just say you just have a portfolio of rental properties that are doing okay. So you've got some profits, you've got some losses. Well, in that case, cost segregation is going to be really beneficial because you're underneath the income threshold where you can take, if you have a loss on a property, you can take that full loss. What we're essentially working around is that passive real estate by default is basically banked, if you will. If you have a loss, you bank it and you can only offset it against other passive income. So if you have a passive loss and you make a lot of money and you don't qualify for any of these, then there's really no change year to year in your overall tax picture, because what's happening to those losses is you're essentially putting them in a loss bank. So if you've got a $50,000 loss and $200,000 of W-2 income, you can't take that unless you have one of these exceptions here. What happens is that $50,000 loss gets banked against next year's earnings. And eventually, as that property starts making money and as depreciation gets phased out, you will lose those. But where cost segregation comes in is when you can absorb those losses now, because what we're going to do is with cost segregation is we're going to increase the loss, which essentially allows you to reduce your taxable income on your tax return. And oftentimes, if you have a standard W-2, a lot of our clients have some kind of W-2 income, they're already paying income tax on their withholdings. And oftentimes, because cost segregation is so dramatic, we end up with really nice refunds. So like I was saying before, that the value of a tax strategy is really how many people you can comfortably analyze and defend. I mean, we're now at over 200 cost segregation studies, and that's not just analyses, those are the actual studies. So we think it's a very solid, not risky, documented way to create tax efficiency if you fit one of these profiles. So let's talk a little bit about the steps. So I'll just go over it briefly. First, we're doing land versus building. So if you bought a $3 million property, how much of that is land? You can't depreciate the land. You'll actually see these corny accountant t-shirts at conferences that say like, I'm going to depreciate land. And it's just a corny way to trigger an accountant. So if you have an accountant in your family and you want to trigger them, go ahead and say you're going to depreciate the land. The point is, we're carving out the land here. It's only the building what's left. And then really the rest of cost segregation is breaking out the building. Once you say, hey, this is the building, this is the value of it. How does this break out into these different categories that have different depreciation treatment? The most common are 5, 7, and 15 years, with the rest being either 27.5 for residential property or 39 years for commercial property. So once you have that building value, all cost segregation is analyzing each component down to vinyl floors, to the fixtures on your doors, into these categories. And then we've got this last thing here, reinvest your savings. So all those, we always tell our clients, all those tax savings that you get, don't go and spend it all in Vegas. Let's find a tax efficient way to reinvest that and keep growing your wealth. What we're doing when we analyze whether cost segregation works is first we'll do a cost benefit analysis. We don't want any of our clients doing these things if ultimately, you don't fit in one of those categories. The cost savings aren't going to be there, and it's not going to make sense to spend a month doing an on-site visit. And then the other thing to consider is recapture considerations. If you're planning to sell the asset soon, all of that depreciation you took is going to get recaptured. So it's essentially going to decrease your basis, number one, but two, that depreciation is actually recaptured. So it comes back in the form of a tax. So if you're planning to sell in the next 2 to 3 years, don't do cost segregation unless you're going back 3 years and selling out 3 years. Because now you've got a good enough differential between cost segregation and sale where that recapture might not be as big of a factor. And again, that's what we're figuring out in a cost benefit analysis. So if you do a cost segregation, make sure you're working with someone that's going to walk you through that, understand what your plans are, and understand your overall tax profile. Because worst thing we can do is spend a month with an on-site visit, do the whole documentation study, and then turn around and unwind all the benefits that cost seg gives you. The IRS is looking at cost segregation, so that doesn't mean not to do it. It just means to make sure you do it right. I think there's a lot of DIY tools out there. It was interesting. We talked to a prospect who said, I think AI can do this. And we said, well, don't call us if this blows up. I think it's very important to note that, look, you just need somebody that has a process that knows how to document it. And cost segregation reports aren't exciting. They're usually 100 pages of asset schedules and tax footnotes. But essentially, that's the checkbox the IRS is looking for. They're not going to beat that up typically on these size deals. We're in the space of $500,000 to $3 million in terms of the assets that we're looking at. The IRS, number one, isn't going to clamp down on that. Typically, what they're doing is they're doing an audit and then just asking for a report if they see accelerated depreciation. As long as you have it, take it out of the drawer, hand it over. They're gonna go on and move on to something else like meals and entertainment. So it's very important that the documentation piece is handled. If you buy a $2.5 million place, by default, trust me, your annual depreciation is going to be $50,000. Essentially, no cost segregation. You've come out a lot in cash. It's a huge cash requirement to buy a $2.5 million property. And this says commercial because it's 39, but you can imagine that's 27.5. Depreciation will go down even further. But the capital requirement's been huge, and your only deduction is going to be $50,000. That's absolutely crazy. Well, if you compare that to accelerated depreciation, what we're essentially doing is we're 10xing that deduction. So I'm going to skip over the details of how to do it because I really want to get it back to Ari. But the point is by working through cost seg analysis, you've essentially changed the deduction 10x. And if you assume a 37% tax rate, a lot of times our clients have other W-2 things going on. You're talking about $143,000 in tax savings. So, if you earn $300,000, you've most likely paid withholding of $40,000. You now have a refund coming back, and maybe some. So these are the types of strategies that we look at when we're talking about investing in real estate. It's something you need to consider. It doesn't apply in every situation. So just to recap, the three categories we really look at is real estate professional status, passive income offset. So if you have other passive income where accelerating depreciation is going to eat into that, it's very, very successful strategy. Self-rentals as well. We really want to get into what you're doing, Ari. So I'm going to hand it over to you.
Awesome. Miguel, we have a lot of clients who use cost seg in the years that they do own, in the early years of their investing career, in the middle of it as well. And then, of course, when they come to us, there's even more of a benefit to doing the 721 exchange with tax deferral. So before we start, guys, I want to just give a quick high level of who typically takes advantage of the 721 exchange, a little bit more on the background of it. So we work with a lot of clients when they're ready to exit, when they're ready to retire from being a landlord. At Flock, we've worked with hundreds of families. Half of them have had very long, successful real estate investing careers, either as full-time folks who owned 10, 50, 100 plus home portfolios, or folks who own just one or two, converted from a primary residence into a rental property, kind of have this as a side project. And so we work with a lot of folks at that point when then they're ready to exit, they're going through a life transition, and they're really ready to retire. We also work with a lot of clients who are much younger. They're in their 40s, their 50s. We've had clients in their 30s, and they were fortunate enough to get into single family rentals or real estate investing. Miguel, I think some of your clients may call it LTRs, right? But they were fortunate to get into the game early, and they've seen a bunch of price appreciation over the last 5, 10, 20 years. And they're really now just at the point where their long-term rentals, their passive real estate portfolio is sort of more hassle, more work than kind of it's really worth. And they'd rather focus their time and their energy on something more active like short-term rentals or they're deal junkies, right? And they like to, flip houses and stuff. And so we work with a lot of different clients, both retirees, the parents of retirees. We work a lot of intergenerational, but also a lot of younger folks.
Let's take a break here. A quick note about the time of the year. As of release of this episode on March 17th, the tax deadline, April 15th, is a little less than 30 days away. We want to share with you a quick public service announcement that this is the last day to pay your 2025 tax liability, whether or not you file or extend your return. We recommend having an idea of what your tax bill is and making a payment by that deadline to avoid interest and penalties. If you're a small business operator, a small business owner, or investor and don't have a tax advisor, feel free to reach out to us at centurionfirm.com/contact. That's centurionfirm.com/contact. We're here to help. Now, let's return to this conversation with Ari Rubin at Flock Homes. Now, Ari, what would you say is the core problem you're trying to solve for clients?
The problem that every real estate owner at some time will face in their life is you can't just retire from being a landlord. Anyone who's owned real estate for a long time knows you can't just hire a property manager and fully put it on autopilot. On a personal level, I own a rental, and no property manager will solve my problems. I'm going through an eviction right now. Flock, unfortunately, won't take my home, which I can go back into later. But as any good owner and good investor knows, if it's your name on title, you're liable for it. And especially folks who built a lot of wealth in real estate know it's your responsibility. A lot of owners that we work with, a lot of good landlords feel a lot of responsibility and sometimes burden towards their residents, which they should. People are counting on us for their homes, and so the problem that we're solving at Flock is you can't just retire from being a landlord. You're always going to be on the hook, whether it's through liability, through surprise expenses. Every part of owning real estate, you are ultimately liable for. So that's the problem that we're solving at Flock. What we've done is effectively create the largest 721 exchange platform in the country. And I'm going to now walk through what the 721 exchange is and the way it works. And so just to sort of summarize this, a lot of folks are probably familiar with what a 1031 exchange is. 1031 exchange is a long-time part of the tax code, section 1031, which says that you can sell real estate, and as long as you adhere to a certain process, and you can roll your gains forward. You can sell your real estate, take the proceeds, roll the proceeds forward to purchase new real estate without triggering depreciation, recapture, or capital gains. You can do that for a long time, of course, kind of till the end, at which point you can pass those assets onto your heirs, who will typically receive a step-up in basis. That's a 1031 exchange. What we've done is essentially make the 721 exchange accessible to the millions of individual landlords who would benefit from it. So what is the 721 exchange? Section 721 of the tax code says that you can contribute an asset into a partnership, into a fund. That means actually selling the assets. And instead of getting cash back, you receive back shares in the partnership. And in doing so, because no cash was received, you don't trigger the typical tax consequences of a sale. You don't trigger depreciation, recapture, and capital gains tax. So in very short, you own an asset. Let's say you own $1 million piece of real estate. You contribute that into a partnership. You now own $1 million, assuming you have no debt. You now own $1 million of shares in the partnership. You have equity now in the partnership. And because no cash was received, what we like to say here, cash is And everyone says cash is king, right? Until next April when you pay taxes on it. And so unless you did a massive study with Miguel, but at a certain point you can't do that. And, you've ran out of bases to do that with. And so really where folks come to Flock is when they've gotten to the point where they have substantial equity, they have very, very low tax basis, and they're ready to step away. They're ready to diversify. They're ready to be a passive shareholder in a larger partnership that owns a diversified institutional caliber portfolio of rentals. So that's, again, what the 721 exchange is. You sell your real estate, you exchange it, you get back shares in a partnership. If you've ever invested in a real estate syndicate, if you've ever bought shares of a REIT, it's very similar. It's not a syndicate, it's not a REIT, but you can sort of think of it the same thing, where you are taking the equity that is currently trapped in the real estate that you own, that you're responsible, that you're liable for. And there's this really clean, seamless, elegant way to exit without paying a massive tax bill, and while still continuing to get all the appreciation, all the income, as well as a lot of depreciation will come back into the benefits from this larger portfolio. So that is at its core what the 721 exchange is. It's been part of the tax code, I think, since the 50s. It's actually, Miguel, do you know what other asset classes? Have you ever seen exchanges for other asset classes?
Yeah, like very niche ones.
You can do it. It's not unlike the Section 1031, which is now effectively a real estate loophole.
Yeah.
It used to apply to art and airplanes. Section 721, it can be done with many different asset classes. So if any of you work in tech or you work at a company, you've worked there for a long time, let's say you were an early Google employee, and you just happened to get $1 million worth of, shares in Google's 25 years ago, and now that's worth, whatever, 50x or whatever it's done in that time. A lot of folks use the 721 exchange to diversify their concentrated stock positions. So it's very common in equities. What's really unique in real estate is you're not just diversifying, you're able to exit from owning your real estate and really be a passive real estate investor instead of being hands-on and being liable, so on and so forth. You're fully passive, right? You no longer have to deal with your tenants. You don't own the asset anymore. You are now just a passive shareholder in a larger fund. With that, you get all the income. You also get all the appreciation. So let's say you put in a house in Austin and you get back shares in the fund. You're no longer just tied to the Austin market. You're diversified, which in certain times that's better than others, right? The last few years, obviously, Austin is a market that's gotten hit pretty hard. The years prior to that, Austin was one of the hottest markets in the country. So you still get that upside, but instead of it being tied to one individual home, it's tied to a larger portfolio. And then lastly, there's a lot of tax advantages to doing an exchange. Not only do you defer the depreciation, recapture, and capital gains at the time of the exchange, you also continue to get depreciation on an ongoing basis. And what's really unique and nice about that, a lot of folks, if you've owned a single family rental for a long time or any asset for a long time, you're probably not doing a lot of CapEx. You're not really kind of maximizing your, both from a tax and also income perspective. It's kind of like set it and forget it.
Right? You're minimizing CapEx at that point.
Exactly.
Yeah.
And at Flock, both because this is a way to drive returns, but also because we're building a brand and we take a lot of care in the hundreds, thousands of residents that we serve, we do a lot of these improvements. We harden the assets. We make them a lot more durable to own over the very, very long term. When that new CapEx is done, that then gets passed through to all the shareholders in the fund. So you still get income, you still get upside, as well as you still get depreciation on an ongoing basis. Now, every quarter you can take cash flow kind of like a dividend, right? Just like you're earning income from your rental properties. Let's say you have $1 million capital account at Flock. We have what's called like a lockup period, the first couple of years where you're a shareholder, you have to stay in the fund, a minimum hold period. And after that, you can request redemptions and redeem from the fund, liquidate your shares. And I can talk through mechanically more of how we do that. But one of the really cool benefits of that from a tax perspective, you come in with a $1 million capital account on day one. And over the next 10 years, let's just say the housing market goes up by 30%. So your account's now worth $1.3 million. By the way, it could also go down. Our goal is to just give you exposure to the housing market on an ongoing basis. But let's just assume your capital account has appreciated from $1 million to $1.3 million. And, you've been working and you're running your business and you're W-2ing and you're just, you're not relying on the cash flow. But 10 years from now, I say, hey, I want to take some cash off the table. If you just own real estate, it's kind of hard to do that. It's very hard to sell $300,000 worth of a $1.3 million piece of real estate. You can do a cash out refi, but a lot of guys, again, this is like your passive rental portfolio that you're not maximizing for. A lot of guys and gals are not really looking to take on debt later in life. It's just not really how they operate. Mm-hmm. What's really beautiful about this structure is when you redeem, you can do so in a very tax efficient way and do it without triggering any taxes because it's treated as a cash out. It's seen as a reduction in basis, mm-hmm. which is similar to a cash out refi. And so you can actually redeem without and take cash without effectively selling and triggering capital gain tax. If you got $2 million in real estate, $1 million in real estate, it's kind of all or nothing. And when you take cash out, you sell and you got to pay the taxes on that. And most folks are really averse to doing that. So this is a way to sort of have flexible cash flow along the way instead of doing it all at once.
That's really interesting. So what you're saying, or if I'm hearing you right, is that the capital account is marked to market. So and is that being done annually?
Yeah. So we mark our books quarterly. So we do an earnings call next week. You guys can all tune in for it. You can also look at every historic earnings calls that we've done to mark our books. We mark it quarterly, and we use a combination of third-party valuations, like what's called an AVM, kind of like a Zillow's estimate type. And we have a whole valuation methodology. In addition to that, we do a random sampling of third-party appraisals every single quarter. Every asset gets appraised every 2 years.
For how many assets?
We now have almost 1,100. We just signed like a 500 home portfolio. Yeah, it's a lot of appraisals. But, we care a lot about, when you're running this fund, we have hundreds of families who are entrusting us with their investments. Transparency really, really matters here. So we have an app. You can go on your portal and you can look at every single home that we own and you can see what it's marked on our books at, how much work, how much CapEx we've done to the asset, what we underwrote it for, the whole valuation history of like 1,100 homes. And I don't think anyone ever, we know what, nobody ever goes and looks through every single home, but you want to be able to. And when folks are due diligencing our fund up front, you want to make sure you're buying into a system and a team that really puts the utmost like integrity and trust in this thing. And so we never deviate from that. We publish our valuations, our mark-to-market valuations every quarter. We do earnings calls. We send out monthly updates. We're really, really transparent about what we own, how our performance is. And that's just frankly a level of sort of transparency that no other real estate fund or REITs provides. And it's because typically their investors, their clients don't really care. Mm-hmm. We're different. Yeah. Our clients, they oftentimes own these homes they built these homes. We have a lot of clients who literally built these homes, mm-hmm. and now 30 years later or 10 years later, they're putting them into flock. So that's how we do our quarterly evaluations. And then of course, at the end of the year, we get audited every year, we do an audit with KPMG. We set up K1s and do a seamless tax kind of end of year reporting also with KPMG. So that's a little bit about our approach to transparency and valuations.
No, that's great. And I think I should just validate the tax efficiency piece is accurate. You can reduce your basis tax-free. So I think the transparency piece is great. I think also sometimes when we hear these too good to be true, anytime I hear tax-free, my BS meter goes off. But I'm gonna give it a green light here.
Yeah, and it's funny, we, in our marketing materials, you can't say tax-free because it's of course tax deferred. But what most folks do, and this goes to the third benefit of Flock in real estate, the goal is for a lot of folks. And we have some folks who their goal is to liquidate over time, and that's going to fund their retirement. And then we have a lot of other folks who have worked really hard to get to the position they're at in life and want to leave something behind for their heirs or for others. Or they use this sort of as an insurance. We hear a lot is like, I don't know what my husband would do, or I don't know what my wife would do if something happened to me. And this way I know it's on autopilot. I don't have to give them keys. I can give them, these shares in this fund. And so, especially if you're passing it on to your heirs, right, assuming it's in a structure and, depending on how your whole estate looks, you can pass it on to your heirs who received a step up in basis, right, and then can liquidate without triggering the same tax bill that the individual who built the wealth would have. So that's one of the really powerful benefits, both to real estate in general, but also to leveraging something like the exchange and a passive investment vehicle like this.
Yeah. So that means you guys need to be ready to be around for a long time.
We're in this for the long haul. Our goal is to build, the next like Vanguard or, of real estate. And we picked to do this. We started with homes. And again, I started this, at the time it was just me with 4 homes. You can go on our website, you see our first client, Shirley. My chief business officer, Chad, was like the first one to join the company, and he was there, and we closed our first client, Shirley. Incredible story. Single mom, physician, middle of COVID. And she had this rental that she had owned for a long time. She used to live in the house, and she had a bunch of equity tied up into it. And she's just like, I don't want to deal. It's like the middle of COVID. I don't want to deal with like a 4-month renovation right now. And so she was one of the first people to put her homes in. We started in Denver with 4 homes. We expanded to Kansas City. And we now have about 1,100 homes. We just signed our largest ever portfolio deal in the Midwest with a really amazing owner. We should hit probably, our goal is to hit about 2,000 homes at the end of 26. But more than anything, our goal is to just continue to have clients love us and to deliver for our clients and for our residents. And as we've constructed this portfolio, we don't take every home. This is something we deal with a lot. Right now, we don't do STRs in Flock Homes. It's all long-term rentals, 1 to 4 units. So we do some duplexes and fourplexes, but it's all long-term rentals in a handful of markets. And our goal in these markets is to take a diversified approach, to be in markets like Denver and Austin, which are markets that are, lots of tech growth and really robust kind of wage growth and get really hot in certain time periods. And then in other periods, they're sort of the laggards. And then also more in yield focused markets like Kansas City and Indianapolis and markets and Cleveland and Detroit and markets that have more of a yield profile, historically less appreciation. So that's a little bit about our fund today. This all comes from just lots of mom and pop owners, professional investors who have owned for a really, really long time.
Now, take us through the process. How does all of this work?
Leading into an exchange. So you can go to our website. You can email me, email someone on the team. But basically the way it works is we underwrite the property that you're bringing to us. We first see, hey, can we take this property? Do we know how to operate it? Does it fit our criteria? So we underwrite the property and we put forth evaluation. And then we do mutual due diligence. And that means you are doing your due diligence on us. You're due diligencing our team, the homes that we own, our operations, what our NOI margins were in Q2 2024. Like, these are questions that people ask and they get into to suss out.
Yeah.
Are we good operators? Do we know how to, efficiently turn and operate rentals? Yeah. So you're doing your due diligence on us. A lot of folks bring in their CPAs. A lot of folks bring in their financial advisors, their friends, their lawyers to due diligence our legal docs and
So
everything.
there isn't a hard close, like
Well,
on the
there,
phone with the sales guy.
no, it's I mean, and it's kind of, it goes the other way too, which is the other side of the due diligence, which is you're selling up. Like, we got to like, not only you, because we're going to be partners together for a long time, but we're looking at your home and we got to say, hey, is that going to fit the standards of our fund? Is that going to, deliver good returns like we've underwritten for the rest of our clients? And so we never compromise on price, on quality, on risk. We could have a lot more homes, but we'd have, bad foundation. I mean, we would take these homes. We don't take homes that have too much debt on it. We don't take homes that are in too bad a condition. So you do your due diligence on us. We do our due diligence on your homes. We decide whether or not we want to acquire it. And that it's usually like a 45-day kind of close process from the time someone first hears about Flock. Sometimes they then say, you know what, I'm not ready for this. Or we say, hey, we can't take any more homes in Texas right now. We need to get more homes in other markets. And then we'll call them back in a couple months, say, hey, we just filled up in other markets. We want more exposure to Texas right now. And so that whole process usually takes about 45 days. Sometimes they push or we push. And then, we close, regular settlement statement. We acquire the home. The client receives shares in the fund. And then they're now, a Flock client. They're an investor in our fund, and they get the returns, cash flow starting a few days later.
Yeah. And I just want to say, I mean, I think this makes total sense when I think about, our clients who are like, hey, I bought this house in 85, basically as old as I am. My gains are like incredible. I've been depreciating this thing forever, right? I've got no basis. Do you think that's part of it, that we've been on this upward trend of appreciation? So you've got this demographic that, bought even in the early 2000s, right? In the '08 great financial crisis. When you look at your clients, like what's the demo that this is like been a home run for?
Yeah. So it's a great question. And I think when I started Flock, I approach this, and a lot of your listeners probably are aware of this too. There's this trend of the silver tsunami, this massive transfer of wealth of boomers who have built so much wealth, who are living longer and they're living healthier, and they want to pass on their wealth eventually to folks. And so that was sort of the target, it was like our parents' generation. That's why I had in mind when I started Flock. There's, every 10 seconds, another person retires. Again, these folks are living longer, and they're going to need an exit at some point in the next 5, 10, 15 years. That was who I really had in mind when I started it. As I then started going to market and we started getting clients, we started seeing a lot of younger clients. And these are folks who either bought in the great financial crisis, they were realtors, they were in the right place at the right time in 2008, 2009, 2010, 2011, 2012. Everyone makes a big deal about Blackstone buying up all the houses in the great financial crisis. But the reality is they actually bought a really small fraction compared to, there were weeks where they were buying $150 million of homes a week. It's a lot of homes, but there were also individual investors on the courthouse steps buying up properties in 2008, 09, 2010, 2011. So we have a lot of clients who bought homes in those years as well. And, it's now 17 years later, and all of those things need to get, we're talking about depreciation, about capital expenditures, and all that stuff needs to be done, and they're just not up to doing it. We also have a big chunk of clients who bought in sort of the 2016, 17, 18, like the 2016 to 21 lead up, run up of prices. Because, Austin, as we discussed, has, home prices have come down. They're still up a lot from 2016 when you bought, and 2017, 2018, even 2019, they're still up a lot, right?
Definitely.
And so we have a lot of clients who either got into real estate investing through a turnkey provider, or they bought a primary residence and then they moved to the next place and they just kept it as a rental. So we've found like niche also, in addition to sort of the older folks who are looking to really retire, with sort of, younger folks or middle-aged folks who are just like, this is not my highest and best use of time.
Yeah.
It's more of a liability. The cash flow on these things are like nothing. Like the yields you get off of a single family rental, it's not worth the time and the effort and the liability. I'd rather just put that equity on autopilot, set it and forget it, and have that be there for my retirement or for my kids.
And I think that's going to resonate with some of the listeners because, I mean, we've certainly seen a huge trend in moving STR to long-term rentals. I think we were talking yesterday that sometimes you can't just take a short-term rental place and make it a great long-term rental. You were talking about your standards. But I think what it comes down to, or where there's alignment, what you just said, is that this isn't the highest and best use of my time. I mean, the requirements for short-term rentals, even with a property manager, can be very, very demanding. And you talk about capital expenditure, the things that go wrong when you've got people coming through like a hotel. But anyway, what I'm validating, what I think is interesting, one is that you've got a few different demographics. And then I think you've got one that I think really speaks to our clients that basically says, how do I take this asset that I have? And going back to what I was saying at the beginning, how do I grow and keep my wealth in a way that aligns with the life I want to lead? And I think at some point, myself, I just sold my short-term rental last year. I'm going to deal with capital gains on that this next year. Your tax professional is not exempt from the same tax rules, and it doesn't make me feel any better about writing that check. But part of it was, how do I find a way to not deal with all the BS that comes from this? And I can only see that kind of compounding as life goes on. So I really appreciate, I think, that angle of what you're doing.
It's also, we spend a lot of time talking to our clients. They send us emails, like personal updates of what they're up to. Like, this is just not, a property manager does not enable this flexibility and this lifestyle. That's not the only way out. Is selling, is exiting. And you did that. And from a tax and kind of financial perspective, that's the only way you can do it. You got to weigh your gains. You got to weigh, what else you're trying to do with the capital, right? But what you said about kind of investing with your values and really values of where you want to spend your time. At the end of the day, right, time is what matters the most. And the best way to get your time back is to free yourself up. And that's where you all have to evaluate, where your highest and best use is, where you have edge. And I think what most folks have realized, right, is they just don't, in their long-term rental portfolio, there's just like not that, the juice just isn't worth the squeeze from a sort of enjoyment perspective, a risk perspective, the yield perspective, which is why a lot of folks come to Flock.
Yeah, definitely. How do distributions generally compare to the cash flow of an SFR? You were talking a little bit. Can you add some numbers or flavors or maybe an example?
Yeah, absolutely. So before we start, I want to try to orient everyone listening, because most people I assume listening are familiar with real estate and they understand how cash flow goes. But I often ask, someone asks me, how much do you pay out or how much you make from owning Flock? And then I say, well, how much do you make owning real estate? And they sometimes, I hope your clients aren't like this, but they'll tell me, they say, well, I make, $3,000 a month in rent. So, and I'm like, oh, do you have any expenses with that?
Yeah.
And, it's funny, the expenses don't come up until the tax return, right? But then they'll say, oh yeah, I guess I have property taxes and insurance. And I'm like, oh, does anything ever break? Like, do you ever do CapEx? Do you ever have a vacancy? No, I haven't had a vacancy in 10 years. Anyways, the short is there are expenses associated with owning rentals. Even if you self-manage, that's your time for property management, right? Or you pay a property manager. So typically the way it works at Flock is as follows. We don't have a set dividend. We don't just pay out a fixed dividend to everyone. We basically, based off of the asset that you're exchanging in, we size up how much cash flow you can take from the fund annually. And so what that means is typically, most people who are coming into Flock, they're going to get less cash flow than they are used to getting. And I'll own that in life in general. If you're going to do something yourself versus you're going to have someone else to do it, you're probably going to get less cash flow. That's just kind of like how the world works. But in addition to that, we're very conservative in terms of the cash that we hold back to have on hand for reserves, right? When you own real estate, you might not put $10,000 away every year in CapEx reserve. you just pay for stuff as it breaks. But we, as a large owner of 1,000+ homes, want to make sure that our homes are always to the standards that our residents want and need. We always have cash on hand, and we're always conservative. So we hold back a lot of cash that just sort of sits in the partnership just to make sure. So when we look at your property, we'll evaluate it, roughly, just to put some rough numbers behind it. If you have a $500,000 rental kind of in a market like Colorado or something, you'd probably expect to be taking about 15K a year in cash flow. That's just like some rough numbers, rough estimate. About half of our clients don't even take the cash flow. They leave it in, kind of like reinvesting, like a dividend increases their basis. And then we have other folks who live on it, like they live on Social Security. They're like, every quarter we send it out, never been late on a cash disbursement. We know people count on it. So we take it really, really, really sacred, which is going back to the conversation about holding back for reserves. We never want to overpromise and underdeliver. So we hold back a lot of reserves. We're pretty conservative in our underwriting. And so, to sum it up, I would say most folks are typically getting less cash flow than they were before, but they're getting peace of mind. They're getting more flexibility. They're never getting a surprise expenditure. And most important, they're getting like long-term wealth preservation, as opposed to just like, oh, is it an extra, am I just taking more money this month, and then something breaks, next month.
Yeah. I mean, having done a lot of the tax returns for rental investors, I mean, I think what we typically see is that, we have to track distributions and contributions. And for some reason, we always see both, meaning that on a typical rental investment, you can take out the free cash flow, but you're typically putting cash flow back in to cover one-time maintenance expenses and stuff like that. But as I'm just thinking about like the last few tax returns I've seen, it's like, we're always looking for both. There's always contributions. And I suppose whole idea of doing a fund with you guys would be that cash only goes one way.
Exactly. You never have to think about it. You're never going to be on the hook for something. And, you probably know this because you just sold an STR. Like, you could have no cash expenditures, like no, contributions for 10 years. And then all of a sudden, I guess an STR maybe is a little bit different, but in a long-term rental, the tenant moves out. And then all of a sudden you're doing a $40,000, value add, or just addressing all the stuff that you didn't do because you bought the house in 2010 in a short sale and whatever. And now that's $40,000. That's your free cash flow from 3 years. Right. And so with this, you never have to think about it. We're never calling you saying, hey, we need cash in. It's just, it's on autopilot, and you just get that quarterly cash flow and you never have to think about it. Total peace of mind.
We evaluate where there's more juice to squeeze. It's certainly true that short-term rentals, the return's going to be a lot higher. But as I was saying at the beginning of the presentation, the scenarios in which long-term rentals get that same benefit is if you or your spouse is a real estate professional. Based on material participation, you can look up those rules, but you can certainly also look on our blog, and we spend a lot of time describing what that is. And other situations, if you have other passive income. So if you've got a bunch of rentals that actually do have yield, and from a tax, maybe you've ran out of basis, so you're actually taxable, and you've got one where you can do cost seg, you're going to be able to offset those gains with your passive losses. So it is beneficial, get the numbers before you actually pull the trigger. I would say there's a lot of companies out there that allow you to kind of self-serve. They're not going to do the analysis. And if they do, they're not going to take all the nuance. So I would say even if you talk to a professional just to get that initial assessment, it's definitely going to be worth it.
Yeah. And by the way, Miguel, just kind of, I want to just echo a point you just made here, because we work with a lot of tax professionals, a lot of CPAs, financial advisors. I think a lot of real estate people have a tendency to try to pinch pennies and that's why they're successful. They're mindful of costs, right? You don't overpay for, a renovation you got to do. You don't overpay for maintenance. You go fix it yourself. There's certain things like tax that it's not worth it. You don't cut corners on, you do it right. You do it once. And that's why it's important when you're not just, dealing with your real estate, but when you're thinking about your nest egg and your overall financial picture, right? It's important that you work with professionals and you work with very, legitimate service providers, and it's always, it's always worth it. So what you said around working, having GPT or something do a cost study for you, like if anyone ever says that to me, I'm saying call Miguel and his team. So
yeah, I love those conversations because I'll show you what ChatGPT does when you ask it a question and it doesn't make you feel good. I think I learned a lot, Ari. It's certainly been a pleasure learning about you, hearing a little bit about your story. I wish we could double click on that, but of course we wanted to get into 721. And I think for a lot of people listening, there's pros, there's cons. I think the point is, look, I think Flock's going to be around for a long time. And I think that a lot of people are, this is going to come up on their journey. And I think when we think of the journey, it's really not one strategy, all solutions, right? It's usually a lot of strategy, one solution. So, yeah, if just want to give you a moment to say, if people want to learn more, how should they find you?
Yeah, come to our website, flockhomes.com. You can send us an email. You can email me. It's ari.rubin@flockhomes.com, info@flockhomes.com. But if you go to our website, you'll be able to find a lot of information about us. And also you can just input your property information and, we'll underwrite the property and we'll start our kind of mutual due diligence process. I'll also say we work with a lot of real estate brokers. So even if you're younger, but you have clients or family members you think this could be a fit for, we work a lot with agents as well as, a lot of other tax professionals, attorneys. So I think this is a cool idea, whether it's now or in the future. We'd love to hear from you. We find it's always better to start a conversation earlier rather than later. Most people wish that they got to know us. We certainly wish we got to know their homes earlier rather than later. So yeah, reach out and would love to hear from you, and looking forward to being in touch. And Miguel, thank you for putting this together. This is a lot of fun and really informative.
Thank you for joining this episode. To make this actionable, I'd encourage you to write down 1 or 2 things that you took away that you can make real in your business. And if you want to connect with me, have questions about the show, or have suggestions on what to cover, I'm pretty active on LinkedIn. You can find me by searching Miguel Alexander Centeno. And if you found value in this show, please subscribe on whatever platform you use to listen to podcasts. And stick around for more. You might just learn something that can change your business.